Are you on a journey of building wealth and looking for certain pitfalls to avoid? Definitely you are in the right place. In this video, we will share with you 12 mistakes to avoid on your wealth building journey. Before we dive in, let's welcome you all to Finance Wheels, the channel with a mission to help you grow your wealth and achieve financial freedom. With that being said, if you are new here, do smash the like button, subscribe, and turn on post notification bell so you never miss any of our content. Let's get started. Most common financial mistakes to avoid when building wealth. There is a difference between being rich and having wealth. Affluence is the surplus of something that is so abundant it cannot be destroyed by any circumstance. Gaining wealth is a different matter from simply making a lot of money. Wealthy people treat their money with care and respect because they understand that nothing grows without attention. And they also understand financial knowledge is a most. If one wants to stay wealthy in their lifetime, here are 12 common mistakes to avoid if you want to build wealth. 1. Seeking comfort, not freedom. The most hazardous aspect of money is comfort, which is the enemy of abundance. Comfort is the foundation of the middle class as a whole. Rich people want abundance and freedom to the point where their efforts no longer produce money. The focus is on freedom. Abundance is the affirmation. Comfort is not on the menu, and more is the mantra. 2. Diversification. Diversifying your investments will never allow you to become truly wealthy. Because diversifying helps Wall Street. Wall Street has done a fantastic job of persuading the public of this. In the words of Mark Cuban, diversification is for idiots. As Andrew Carnegie once said, "Watch that basket and put all your eggs in it." Gain as much knowledge as you can about a field and give it your all if you want to generate genuine wealth. 3. Depending on one income flow. Don't rely solely on one source of income, regardless of its size. One executive I knew made $300,000 a year, the top 1% of all salaries. Her only source of income abruptly stopped, and the industry she worked in collapsed. Trillions of dollars of pretended wealth have been destroyed as a result of this happening to many Americans. 4. Investing in things that will generate steady income streams separate from your primary source of income is necessary to build wealth. I deviate from passive income streams by renting out apartments and taking partnerships in other businesses. In order to strengthen each of these flows, I keep observing them. This is fortification of wealth, not diversification. 5. Comparing to others. 66% of Americans in the workforce are living paycheck to paycheck. You will never become wealthy if you judge your financial situation by that of others. Many use the comparison to some starving country in the far corner of the globe to make themselves feel better off. Good or bad, your bills won't get paid, your retirement won't be funded, and you won't feel at ease because of someone else's money. Keep your financial situation apart from other people's. 6. Investing in trends. Keep in mind that new technological advancements may displace your investment in the newest and greatest technology. Soft drinks, food companies, candy, banks, railroads, and electricity are among the industries in which Warren Buffett has held investments. Refrain from boarding the wave car. Select the more leisurely and prolonged route that ensures your reach. 7. Trusting without proof. I made the biggest financial mistake of my life when I blindly trusted a group of people just because I liked them and it felt right. I forgot to get evidence that they were who they said they were. Rather, I followed my emotions and ended up being duped. I had lost millions by the time I realized there was a problem. When it comes to people, set aside your emotions and always seek credible proof. It should be standard procedure to avoid doing business with someone if you are so close to them that you are unwilling to ask them for proof. 8. Saving to save. Saving money alone will never allow you to build true wealth. The banks are the only ones who pay 25%, so if rates stay the same, it will take you 40 years to see a 10% increase in your money. More importantly, idle money somehow always finds a way to fund an emergency. According to Dave Ramsey, if you carry cash or credit cards, you'll find an excuse to use them when they're available. Since I was 25, I have moved extra money into future investment accounts that I could not easily access in order to ensure my wealth. This way, when the time came for me to invest, I would have the knowledge and guts to do so. I had to work hard and stay broke as a result of this. 9. Pretender spender. Presumer spenders are at the other end of the spectrum. By their financial behavior, they aim to impress others. Money is never theirs. it's always someone else's. The list is endless and includes luxury clothing, sports cars, VIP tables, designer bags and shoes. Rich people want freedom. They don't want to impress anyone. When the wealthy experience prosperity and abundance, they begin to frivolously spend their money on vehicles, boats, jets, and vacation homes. By then, the fact that the items are bad investments is irrelevant, although the extremely wealthy may seem to be showing off their wealth with extravagances. This is not the case. The abundance they have created outweighs the tiny amount of money they are spending. Doesn't that sound nice? Which will it be for you then? Middle class, wealthy, or rich? You already know that merely getting by and having money won't make you happy. Every decision you make has an associated cost. Having wealth gives you options, and freedom belongs to the one who has options. 10. Alcohol and drug abusers. Drug abusers frequently struggle with the financial consequences of their addiction. Addiction is a sickness that consumes your existence. The more physically dependent you become on the drug, the more likely it is that your mind will be consumed by thoughts of your next fix. An addict may find it challenging to prioritize their finances and abstain from drugs as a result. Money problems and drug addiction are related for a number of reasons. Many would-be millionaires suffer because of this one habit. 11. Not planning ahead with a budget. You can't keep track of your spending, savings progress, or available funds without a budget. Simply put, a budget is your financial compass. Without one, it's simpler to develop bad spending habits. Be careful to include savings, needs, and wants in your budget planning. A popular budgeting strategy is the 50-30-20 rule, which states that you should allocate 50% of your income for necessities, 30% for wants, and 20% for savings. If you want to have a little more flexibility with your spending and avoid feeling pressed for cash at the end of the month, it could even be a good idea to slightly underestimate your monthly income. Even with a budget, it's simple to forget about savings and go over your allocated spending limit. Putting money into your savings account at the end of the month after you've paid for needs and wants is a common bad savings habit. This will allow you to save the meager amounts of money that are left over from your monthly salary and allow you to take use of those savings while they are still quite accessible. Put the amount you have saved in a savings account as soon as your paycheck is deposited to break this habit. Savings accounts typically only permit a certain number of transactions per month, which deters people from accessing their funds and spending their money. Certain finance apps have the ability to automate the savings process, automatically depositing a portion of your paycheck into a savings account as soon as the money is deposited. 12. Having no emergency fund. 57% feel uneasy about their amount of emergency savings, per Bankrate's 2023 Emergency Fund Report. Some may choose to prioritize other savings objectives over emergency fund contributions, or they may not be making any contributions at all. Even if budgets are tighter due to increased inflation, emergency savings should still be allocated. Your ability to pay for unforeseen expenses with cash, rather than adding to your debt by using a credit card or loan, is dependent on these savings. Look for areas in your budget where you can make small adjustments to stash more money and save any windfalls, like a tax refund, to begin building an emergency savings fund. Because online savings accounts typically yield significantly higher returns than traditional savings accounts, you might want to consider keeping your emergency savings in one of these. And there you have it, a rundown of things to avoid if you want to be rich. If you found these insights valuable, don't forget to hit that like button, subscribe for more financial wisdom, and share your thoughts in the comments. Remember, building wealth is a journey, and steering clear of these pitfalls will put you on the fast track to financial success. Until next time.